And income, what that means, Tara Lynn, is we're going to calculate based on how you're paid your gross monthly income. We're going to compare that to a proposed monthly housing payment plus any other monthly debt you have, like an auto loan, student loans, things like that. And we calculate what's called a debt to income ratio. And different loan programs have different debt to income ratio requirements. And then finally, assets, that just means, hey, where's Tara Lynn's money coming from for the down payment and closing costs? Is it coming from your checking and savings? Are you getting gift funds? Do you qualify for down payment assistance? So that's credit, income, and assets. And then to give you just a brief overview of IHDA, and you may be familiar with this, but IHDA is an acronym that stands for Illinois Housing Development Authority. It's a state agency, and they allow sponsored lenders to participate in their programs. And Wintrust, we're a sponsored lender, obviously. We're actually the largest IHDA lender in Illinois. We do more IHDA loans than any other lender. And all IHDA loans have some general characteristics. One of them is you must have a 640 middle credit score. Okay, so that's number one for IHDA. Number two, you can't make more than $109,200. And then your debt to income ratio cannot exceed 45%. Okay. So now let's talk about the new program that I think there's going to be a lot of interest in, the Smart Money program. And I don't know if you want to bring up the slide, April.
Right here. Hold on. Those are the ones I have. Smart Buy.
Smart Buy, yeah.
There we go.
Okay.
And I have this one. And I have this one. I have the opening doors.
Did you, for some reason, I can't see the Smart Buy one. Did you open it up?
Yeah, right here. Can you see my screen?
I can. It's just showing like PowerPoint, and then, but it doesn't show the. Oh, here we go. It's changing now, I think.
Here, hold on. Let me go back.
Okay, there it is. Perfect. Thank you.
Is that good?
Yes, absolutely.
Make this full screen too.
Okay, so the Smart Buy program, essentially the spirit of it is to help individuals who have, want to become homeowners, but obviously a big obstacle is the student loans that people have. They're kind of holding them back. So the spirit of this program is to try and get the buyer some money to pay off not only some student loans, but also to get some down payment assistance. So essentially how the program works is you get 15% of the purchase price of the home up to $40,000. And what's important is you must pay off all of your student loan debt. And I know that's what you would want to do, but let me give you an example by what I mean. Not everybody's going to fit perfectly into the box, so to speak. So let's say you are purchasing a home for $200,000. So 15% of $200,000 is $30,000. So you get $30,000 to pay off student loans. However, let's say you personally, individually have $40,000 in student loans. Well, you would have to come up with $10,000 of your own money. So that's where it gets a little bit tricky. But let's say you only had $20,000 in student loans, then you could pay off all of them and the program would work nicely for you. And the other thing, another important point about the program is if you are buying with another person, you cannot partially pay off that other person's debt. Once again, you have to pay off all or nothing. If it works out to just pay off your individual debt, that's great. Maybe it would work out to pay off both buyers. It just depends. And then the other important point is there are different loan types out there. The two most common are conventional and FHA. Conventional is for buyers that have, pretty good credit scores, and you have to come up with a minimum of 5% down. FHA is typical buyers. They may have had some credit issues in the past. Their credit is not perfect, so they go FHA. Great program. I close FHA loans every single month. However, with this particular IHDA program, right now, they're only allowing conventional loans. So that's another very important point to understand. And then finally, with this program, not only does it pay off, hopefully, your student loans, but you also get $5,000 in down payment assistance. And that $5,000 does not have to be paid back. It's forgiven over 5 years. So as long as you're there for 5 years, you don't have to pay any of it back. If you were to sell prior to the 5 years, you would pay a prorated portion back. So if you sold after year 3, when you sold the house, you'd have to pay $2,000 of it back. The student loans, however, that part of it is forgiven over 36 months, and no payment is required. So terrific program. It's brand new. It's only been out maybe just over a month, and I have a feeling there's going to be quite a bit of interest in it.
That's really great, Bob. Can you talk about some of are there other IHDA loan?
Yeah, so the other new program that's attractive is called Opening Doors. And this program gives you $6,000 that is forgiven over 5 years. Once again, forgiven over 5 years.
Let me go back to that slide. There.
Once again, if you were to sell before the 5 years is up, you would pay a prorated portion back. So if you sold after year 3, you would have to pay 40% of it back, or $2,400 when you sold your home. There are 3 other IHDA programs that are available for buyers. They're not as attractive as this 6,000 opening doors program. One of them gives you 7,500, but you have to pay the whole 7,500 back once you sell the house. Okay. So, I mean, it's a nice program if you need more than 6,000 and, funds are tight, you need a little bit more help to get into a home. It's a nice program. I've done some of those. And then there's another program that gives you up to 10,000. That program, you have to pay the money back on a monthly basis, but you pay it back at 0% interest. So you can get the full 10,000, but you pay it back every month, 0% interest. It winds up being an extra $83.33 to your monthly bill, your monthly housing expense. But these two that I went over tonight in more detail, these are the more popular ones. Obviously the student loan one, and then this 6,000 opening door, because it's fully forgivable over 5 years. It's nice that it's forgivable.
And if somebody has some credit issues, what's the best way to clean up your credit in order to be able to qualify for a mortgage, you would say?
Well, the big stumbling block that I see quite often on people's credit reports is, they have collections, maybe they ran into some trouble, they weren't able to pay the bills, and then those bills go to collection. Those typically will bring down your credit scores. So if you have the money to pay those off or negotiate a settlement on those collections, that's number one, to help your score. The other way that I've seen people be able to help their score is, once again, I mean, easier said than done. You got to have the money, but let's say people have several, buyers have several credit cards, and those cards have high balances in relationship to the credit limits. That's going to hurt your score. So I'll give you a for example to clarify that. Let's say you have a Visa card and the limit on that Visa card is $1,000, but your balance is $900. You're at 90% of the limit, right? That's going to hurt your score a little bit. If you're able to bring your balance and keep your balance under 30% of the limit, so under $300 in this example, you'll maximize your score. So sometimes I have people that come to me and they just don't have the credit to qualify for a program. I mean, overall, their credit looks pretty good. They pay their bills on time, but their credit card balances are at the limits. And then they pay down below 30%. Sometimes we'll see their scores jump 50, 60, 70 points. So those are usually the two ways, but I always tell people, you know, if you want to apply for a loan, there's no cost or obligation. We do pull credit. We can take a look at your credit and offer advice and possibly a plan to help position yourself to become a homeowner.
Sure. Hey, Tara Lynn has a question. Go ahead.
Now, Robert, I got a quick question. It was based off collections. So say a person has collections and they decided to pay it off. Does that start the cycle over again? Or does it like, okay, hey, you paid that off on your, you paid it off, eventually that'll fall off? What's that process?
Yeah, so if the collections are, normally these collection companies are reporting current, meaning if you look at a credit report, it has what's called a report date. And a lot of times, even if these collections are 4 or 5 years old, these companies are still reporting them as current, meaning, hey, we're still trying to collect them. If, however, the report date is over 2 years old, then a lot of times we don't necessarily need to worry about the collection because a lot of these are typically medical. So if they're older than 2 years, we typically don't need to worry about them or pay them off. A lot of times when you're purchasing a home, if you qualify, you're pre-approved and you do have medical collections, we don't necessarily need to do anything with them. But the point I was trying to make is if you do have low scores, we can usually analyze the credit report. And a lot of times it is because of some current collections. And so to help yourself, you're going to want to pay those collections off.
Okay. Do you need any kind of proof, after you've paid those off?
Well, creditors are required by law to update the bureaus every 30 days. So I always tell people, if you do pay off a collection or work out a settlement to pay it, get something in writing from them just as backup. But they are required to report to the bureaus and update the bureaus.
Mm-hmm. Wonderful. Anybody else have questions? The lender is the most important part. I mean, working with a realtor is important too, but you have to have your finances together and get your money together and then be able to move forward into buying a house. So If you have questions, Bob's the man. I met him through a non-for-profit called Home DuPage. It's on Roosevelt Avenue in Wheaton. And it's a credit counseling. They have first-time buyer counseling sessions to walk people through buying a house, getting their credit cleaned up so that they can buy a house. It's a really nice non-for-profit. So Bob does a lot of the IHDA loans, and I thought he'd be a great person to come on and to talk about those and answer any questions people have. So thanks for joining us. Hi, John. I have my screen shared, so I can't see the chat.
Does anybody else have any questions about the pre-approval process, how it works? Essentially, I can tell you, essentially what you do is you submit an application, which is, your personal information, employment and income information, and some bank account information, approximate balances in your different accounts. And then what we do from there is we pull a credit report, and all of your credit information gets uploaded to the application. And then we do what's called run the pre-approval. The pre-approval program is essentially a risk-based software model. And there's two main ones out there. One is Fannie Mae's, which is called Desktop Underwriter. And the other one is Freddie Mac's, which is called Loan Prospector. Fannie Mae and Freddie Mac, for those of you who don't know, are the two government-sponsored agencies that develop all the guidelines for conventional lending. And those guidelines are embedded in the pre-approval program. And when we run the pre-approval, it tells us if you're pre-approved. And it doesn't tell us that, for example, you are pre-approved up to a certain amount. We actually have to input some estimates for purchase price, real estate taxes, home insurance, and if you're buying a condo or townhouse, an estimate for association fee. And then it tells us if you're pre-approved at those numbers. Mm-hmm. So that's essentially how the pre-approval works. It's good for 4 months. 4 months because that's how long a credit report is good for. A credit report expires after 4 months. And then when I issue the pre-approval letter, I will, email a copy of the pre-approval to both you and April, along with the parameters in which I ran it. And that's where April takes over, and she's going to query homes for you in the area you're interested in based on the pre-approval factors. And then you guys start your home search.
Mm-hmm. Yeah, and we work off that budget from the lender just to make sure, you can afford the house. And maybe Bob tells you, hey, you can afford $280,000 and this is what your payment will be. And you'll say, oh, I don't know if I want my payment that high. So then we'll work within whatever your payment you're comfortable with.
Yeah, that's a terrific point, April. We may get you pre-approved up to such and such amount, but ultimately you have to feel comfortable with the payment, based on your lifestyle, what you've got going on. We have a lot of your information on a loan application. We have a lot of your information when we pull the credit report, but we don't know certain things. For example, maybe you're taking care of an elderly parent, that can be expensive, or maybe you've got kids in private school or daycare, that's expensive, and that stuff doesn't show up on your credit report. Mm-hmm. So another thing that we can do is you can say, here's the payment I feel comfortable with. We can work backwards and then say, okay, here's what you need to be looking at then. So we can work backwards as well.
Mm-hmm. Yeah, I always keep that in mind because like when I was buying a house, we got pre-approved for like a crazy amount of money. And I was like, oh my gosh, like, I don't want to have that payment. So we understood, you know, what our budget was. And you have to take into account, you're going to have utilities. If things break, you want to save a little money in case, you know, you have to fix things. You'll want to fix up the house at some point. You know, change the flooring, paint, do things like that, buy different furniture. So
There's always expenses as a homeowner, that's for sure.
yes, that's it. One of the pleasures of home ownership. We could talk about down payments. So maybe we could go over the FHA again, because John and
Yeah,
we had some other people join in.
for sure. Yeah, so there's, unless you're a veteran, and if you're a veteran, then one of the best benefits that you can take advantage of, in my mind, is the VA loan. Because you can put 0% down. The interest rates are phenomenal. And again, it's just a terrific benefit if you're a veteran. But if you're not a veteran, the two main loan types you're going to be looking at are either FHA and conventional. Conventional, typically you're going to get very good terms if you have good credit scores. I would say, you know, low 700s typically or higher, you know, sometimes, you know, upper 600s, but conventional interest rates are very sensitive to credit scores. So if you have a middle credit score of 740, you will get the best rate on conventional. And then if your score is less than 740, then the rate starts moving up on conventional. And conventional, you have to put down a minimum of 5%. There are some programs that will allow 3% down if you're below 80% of what's called the median income for that area that you're purchasing in. So that's conventional. FHA, you only have to put 3.5% down. And if you have less than perfect credit, let's say your scores are in the mid 600s, you know, you'll have a much easier chance getting approved going FHA. And the interest rates are just as good as conventional. The kicker is there is more what is called mortgage insurance. Mortgage insurance is insurance that you pay for that protects the lender in case of default. Going back to conventional loan, you're going to have mortgage insurance unless you can put 20% down. On an FHA loan, no matter what, you're going to have mortgage insurance. And the mortgage insurance tends to be more expensive on FHA, and that's what allows FHA to do those types of loans. But they're both terrific products. I do close both conventional VA and FHA every single month.
LaShandrea asked, if I received a pre-approval in December, should I wait until April to apply again?
Yeah, I mean, if you are working with a loan officer, LaShandrea, then that pre-approval, again, should be good for 4 months. If you're not ready to be out there yet, then you're not ready. And then I would just reapply once you are ready, because then they're going to need to pull a new credit report. And as long as you don't have a lot of inquiries, you know, it's not really going to hurt your score, but the fewer inquiries, the better. So I would wait until that credit report is expired, which credit reports expire every 4 months.
Have you been out shopping for a house, or you were hoping to be approved for more?
I was hoping to be approved for more.
Mhm.
So that was the issue. So I didn't feel comfortable. I didn't think the figure was right. I do have a high student loan amount. And then I did ask about conventional because I was working with a housing program and she did recommend conventional to me. But when I spoke with the realtor and she spoke with the lender, for whatever reason, they still did FHA. So now I was a little upset about that. So I'm like, okay, well, now I guess I'm going to have to wait. I thought it was 90 days, but I'm hearing tonight that it's actually 4 months. So that's why I asked the question. So I guess now I would have to wait until April.
Well, as long as, let's say, LaShandrea, that the loan, I'm going to use nice round dates for this example, but let's say someone, they pulled your credit on January 1st, they can use that same credit report in most cases, as long as you close by April 30th. So let's say you applied January 1st, you got out there for a few weeks, you were looking at homes, you didn't see anything. So you say, you know what, I'm just going to put it on hold for now. And you jump back in March 1st and you find something right away. They should be able to use that same credit report as long as you close prior to April 30th, if that makes sense.
It does, but if I don't, and say I start back looking in March and I don't find anything, then I would need to reapply. But I actually want to go with a different lender.
Okay. Okay.
And sometimes you can get them extended out too. Like, I know I've had where maybe we haven't found anything, and so that we get a little extension on our pre-approval.
Okay. No, I prefer to go with a different lender. I don't think they were helping or trying to service me the best they could.
I see. It makes a difference. Here, I'll put Bob's information up so that you guys.
Yeah, feel
Okay.
free to reach out to me with any questions. I'd be more than happy to try and help you.
Okay, I appreciate that.
Here's all Bob's info. And I can email that to you too.
Okay, that would be great.
What else can we help you with? We're here. You have a realtor and a loan officer at your service for the evening.
That's great. I did have a question, and I don't know if we're going to get to that part or not. So I was just waiting to find out about houses that need to be rehabbed. I didn't know if it was like a rehab loan program, or I didn't know if we were going to get to that tonight or not.
We could talk about that, Bob. You could talk about the renovation loans.
Sure. Yeah. So I don't know if you were on the call at the very beginning, LaShandrea, but I was talking about how all loans are approved based on 4 factors: credit, income, assets, and collateral. The first 3 have to do with you, and then collateral, that just means the home must appraise out and it must meet certain minimum standards. Some homes don't meet certain minimum standards, or maybe the home does, but you want to get some additional funds to rehab the house or fix it up before you move in. Well, there are specific types of loans that do that. FHA has a product if you're an FHA buyer, and conventional also has a product if you're a conventional buyer. And they both work pretty similarly. The funds that you get for the rehab are based on the future value of the home once the project is completed. So the appraiser is going to look at the home the way it exists now, and then they're also going to look at the plans, and you have to have a licensed general contractor. You can't do the work yourself. And so they're going to look at the plans and contract or estimate, if you will, that the contractor puts together. and determine what the future value is of that home. And if you're going conventional, you can borrow 95% of that value. If you're going FHA, you can borrow 96.5% of that value. And then the money for the project is held in a separate, what's called escrow account, or separate account, if you will. And the builder is paid on a completion basis. So depending on the size and scope of the project, you know, the builder may get 2 draws, they might get 5 draws, but each time a draw is requested, the appraiser has to verify that the work is done. You have to agree to it. And then the builder is, you know, funds are released for that draw and given to the builder, so on and so forth until the project is completed. But I will tell you, I have done these for first-time home buyers before, but they are a bit more complicated. There's a lot more work involved, and I would tell you, ideally, if you can find something that you can just move into that's, you know, probably, you know, might be better, because again, it does require a lot more work, patience, and you know, it's a longer process, if you will.
Yeah, you have to use like licensed contractors, and there's steps involved with the renovation loans.
Okay, that's good to know.
Hmm. And a lot of times, you know, we could find homes that are more move-in ready. Maybe you have to do a few things, but it's not like total gut rehabs and things like that. I always feel like those gut rehabs or buying foreclosed homes, things like that, those are more for um, maybe an investor buyer or somebody with just a little more that are handy, can do some of the work themselves. It'll save you a lot of money, and you'll know what you're getting into. Uh, for people that aren't very handy or knowledgeable about homes and construction and things, I feel like those foreclosure homes or maybe the distressed properties are a little too much. You're already maybe at the top of your budget. That's why you're looking at maybe something like that. And, you know, then you have to put more money into it in order to get it livable, or, you know, just to fix it up. And so I always look at homes that are more move-in ready, especially for first-time home buyers. Paint and carpet aren't that, you know, paint, flooring, those type of things aren't as expensive to do as, you know, some renovations. So luckily, you know, everybody I've worked with finds a good home that fits their needs overall. It might take some time. You might feel a little frustrated, like I'm not finding anything, but eventually you do. What else?
Well,
We had
thank
some
you.
other people. We had some other people join in late, so thanks you guys for coming. We appreciate it. And Bob's really been just talking about financing. I feel like that's always the main topic people want to talk about, is getting their finances together and ready to buy a house. So if you have questions, please feel free to chime in. He was just talking about renovation loans. We sort of covered the student loan programs. If maybe you want to talk about those again, Bob, because we had some people join in late.
Yeah, I'll touch base on the smart money IDA program. So this is a new program from IDA, and the spirit of, if you will, of the program is to try and help young buyers become homeowners. And one of the biggest stumbling blocks is student loan, the load of student loans that young buyers have. And so what IDA has done is they came up with this program where they will give you up to 15% of the purchase price with a maximum dollar amount of 40,000 to pay off student loans. And not everybody will fit into the program. And I'll give the example I gave before. You have to pay off all of your student loan. You can't partially pay it off. So for example, if you're buying a home for 200,000, you get 15% of that. So 15% of that would be 30,000 to pay off your student loans. If you have 40,000 in student loans, you would have to come up with $10,000 of your own money. You can't partially pay it off. It's all or none. So however, you only have, but if you have 25,000 in student loans, then in this scenario, the program would work great. The other important thing to understand is right now, this program is only available on a conventional loan or Fannie Mae loan, if you will. It's not available on FHA yet. Hopefully it will be. And then finally, it gives you, in addition to paying off the student loans, it gives you $5,000 in down payment assistance as well, which is forgivable over 5 years. Meaning if you were to sell the home before the 5 years is up, you'd have to pay a prorated portion back. And the student loan piece of it is forgiven after 3 years, 36 months. So I think, this program is barely a month old, but I really think there's going to be a lot of interest in this program. Obviously, if somebody can get $25,000, $30,000, $35,000, $40,000 in student loan debt paid off, I mean, that's pretty big.
Huge, huge. And then here's let's talk about this other IDA program too.
Sure. Yeah, this one called Opening Doors. This works like almost all the IDA down payment assistance programs. This program provides $6,000 in down payment assistance, forgivable over 5 years. So once again, you don't have to pay any of it back as long as you're in the home for 5 years. If you were to sell prior to the 5 years being up, you would pay a prorated portion back when you sell. So for example, if you sell after year 3, you would pay 40% of it back or $2,400 back.
Had a question about rules of getting a mortgage after a bankruptcy for both FHA and conventional.
Sure. Yeah. So there are different what are called waiting periods for financial events. So for a bankruptcy, the waiting period after discharge is 2 years for an FHA loan and 4 years for a conventional loan. And then the other, another one is foreclosure. If you had a foreclosure, once that foreclosure has been fully completed, the waiting period for FHA is 3 years, and it's actually 7 years for conventional.
How about for a short sale? Is there a waiting time?
Yes, short sale. I'd have to check my cheat sheet. I believe it's also 3 years for FHA and 4 years for conventional, but I'd have to double check on that one.
I think that sounds right. 3 years. I just had a buyer who was able to purchase, and yeah, we sold her. We had to short sale her townhouse, and I want to say that was 3 years ago. And then this year she was ready. She was able to buy under FHA, and then she could refinance out. She was just a little shy to get the conventional for her purchase, so she was going to refinance down the road a little bit.
Yeah, out of the FHA loan and into a conventional, sure.
Yeah. That's good though. I mean, you don't have to wait too long
No.
after those events. What else can we help you with? Trying to think what situations I've had. Do you think that is the DTI higher for FHA? What's the difference with housing ratio?
Yeah. So just to back up a second, I did quickly look up the short sale waiting period, and yeah, I was correct. It's 3 years FHA and 4 years for conventional.
Hmm.
Um, so, and then ratios. So most conventional loans require, or they want to see that your total debt to income ratio is under 45%. Okay. Um, they do make some exceptions and will go up to a maximum of 49.9% if you have a very strong profile, meaning maybe your debt to income ratio is high, but you have sky high credit scores and you have what are called good reserves. Reserves means you have money left over in the bank, whether it's a savings account or 401k or whatever after the transaction. FHA is more lenient. They will allow you to go above 50%, and Wintrust will allow you to go, the company I work for, up to 55%. As long as you can get pre-approved.
Hmm. Good question. Do you feel like some of the guidelines are opening back up now? I know things tightened up with COVID, and what do you feel like's
Yeah.
happening in the future?
Well, things definitely tightened up with COVID. So, for example, Wintrust and most lenders did the same thing, but our minimum middle credit score for FHA was only 600 pre-COVID, and now it's actually 640.
Mhm.
That has not changed. They actually, uh, what they did when COVID hit, a lot of lenders were fearful of losses due to people, job loss, not paying the mortgage, et cetera, et cetera. So they looked at what are considered riskier loans, and they tightened up guidelines on those types of loans. And I haven't really seen them loosen up those restrictions too much yet.
Mhm. What do you feel about like the deferment program
You mean the student?
where people were able to put their mortgages into forbearance?
Oh, well, I mean, I think that helped a lot of people. So it was a nice program. Um, if, there are different rules regarding uh, deferment forbearance as well. If, for example, I had, obviously this past year was a huge year for refinancing with the interest rates moving so low.
Sure.
And if you were in a forbearance program, you had to um, cancel it and then also bring yourself current if you wanted to refinance. So there were different rules regarding forbearance as well. But as far as was it effective? Yeah, I think it helped a lot of people.
Mhm. Somebody's asking if Wintrust does IDA loans. I said, yeah, Bob is the expert.
Yeah, we Wintrust. You probably weren't here at the very beginning, but I was saying that we are actually the number one IDA lender in the state. We do more loans than any other lender in the state of Illinois, IDA loans. So.
Let's see who else is with us. All right, guys. How else can we help? I appreciate everybody joining in. We got some
Yeah.
good questions.
Yeah, thank you, April, again for putting this together. And it's nice that everybody can join the call and spend some time with us. So thank you.
Oh, sure. I know because people have been asking me about programs, and it's just not my wheelhouse. I love homes, and so I love to sell the homes, but I don't know about the financing. And it seems like programs come and go, and so it's nice to turn to my partners to have them in their expertise. For sure. Any realtor questions? Anything I can help you with as far as realtors? Do you have a realtor? Oh yeah, I could find you a realtor that works in the south suburbs for sure. Cook County. Oh yeah. For sure. Where are you looking at?
Like Glenwood, Park Forest, Country Club Hills, Flossmoor, Homewood area.
Okay. I'll get you somebody. My sister-in-law lives in Homewood, Flossmoor.
Oh, okay.
Mm-hmm. My husband's kind of from the south side, so yeah, I helped the girl too. She was in Blue Island, and we bought a house over in Park Forest.
Oh, okay.
Yeah, nice areas. And Homewood Flossmoor is really nice.
Yes. And Park Forest have a lot of homes for sale now.
Mm-hmm. I don't know about the market over there so much. I'm in the western burbs, but
Okay.
yeah, I'll find you somebody for sure.
Okay. That would be great.
They'll take good care of you, girl. Oh, what's the difference between listing contingent and under contract? They're the same. There's just different contingencies. So sometimes when you first go under contract, they call it attorney and inspection contingency. And so you're going through the attorney review, and also you're doing your home inspection at that time. Here, let's go back to my section. Let's see, this is talking about getting an agent. Let's go forward. And then sometimes there's contingencies where if somebody has a house to sell, they have to sell their house in order to buy a house. So there might be a kick out, like if that house doesn't go under contract by a certain date, then you might lose out on your buy. So there's just different contingencies, but mostly contingent and under contract are the same. And that attorney review period is about 10 days. And it takes about 30 to 45 days to go through the whole process from going under contract to closing. What is your closing time, Bob?
Well, we try and accommodate the closing date on the contract. So if the deal is put together where we have to close in 30 days, we'll do that. Right now, like a lot of companies, we're experiencing really high volume.
Mm-hmm.
So we do ask agents, hey, can you give us 40 days? Can we work with that? And most of the time we can get that. But if you were to come back to me and say, well, no, in order to make this deal work, we have to close in 30 days, then we're going to accommodate you.
Mm-hmm. It's hard right now because the inventory is like so low. It's crazy low. So You know, if you're thinking about getting in the housing market to buy a house, it's super competitive. So work with an agent who will manage your expectations and get you to the closing line. Okay. Because of COVID, inventory is down about 30% across the board in many price ranges, and especially the entry level price point. There's multiple offers. People are having to pay over asking price, sometimes not getting credits, you know, for repairs and things for the house. So it's just, it's a crazy time because of COVID. So we're finding, you know, sometimes we have to negotiate that that closing date. But you know, I'm finding that the seller is concerned too, that they're not going to find a home to move to. So you know, we can coordinate a longer closing date, maybe give them a little more time to go find a house themselves. Because many times the seller needs to have their house under contract before they can go start shopping for a house because of contingencies. Here's a good one. Should you buy a condo, a townhouse, or a single family house? Sometimes it depends on, you know, if you want to do maintenance on the house, on the yard, you know, those type of things. And sometimes it's what you can afford too. So you can always consider a condo or a townhouse is just like your starter home, and then be able to move up into a single family home, say within 5 years, be on a 5-year plan. And sometimes having a condo or townhome, maybe you'll keep it as an investment property and be able to rent it out in the future. And then you could move up into a single family home. So like I have a cute little townhouse in Addison for sale. It's a 2-bedroom, 1.5 bath. It's $135,000, and the payment on that would be about $1,200 a month with the HOA and the taxes and your house payment. And that's less than rent. And it's rentable, so that you'd be able to keep it if you wanted and rent it, you know, and move into a bigger place in the future. So it's just can be a good stepping stone to build wealth. What else? We're here for you guys. One thing I'm seeing, like I said, in the market is a lot of the multiple offers because there isn't a lot of inventory. So just be aware and don't feel frustrated. You might lose out on a couple, but you'll get the house eventually. Like I'm just working with a buyer. We finally got a house to stick on the 3rd time, but it's one of the better ones. So, and many times I won't let you settle. I say, okay, I think we could find something better, because you can always tell when it's that house for that person and it's a good fit. But you get into the market and it feels like a frenzy when you're going and you see all these people, you know, there's a line of people to get in the houses, or you go to open house and the open house is busy and it gets a little like, oh my gosh, I'm going to miss out. And so you have the FOMO, you know, fear of missing out. But it always works out in the end. I promise. Nobody's been homeless yet. All right, guys. Well, we're coming up to 8 o'clock. Can I answer any more questions for you? Bradley or Mr. Pepin? Tara Lynn? Well, I'll email you guys Bob's information and my information. And if you need any help with anything, you know, feel free to reach out to us. We're here to help you answer any questions. And I thank you guys for coming tonight.
Thank you, April.
Yeah, you're so welcome. Thanks, Bob. I appreciate your expertise.
You're very welcome. Happy to help.
All right, awesome. You guys have a good night.
Okay. Bye-bye.
Bye.